right. Well, good morning. Hello, welcome. I'm Deanne Rosso, President and CEO of Elevate Wealth Advisory, and we're happy that you're joining us today for tax planning through the four stages of retirement. The word wealth comes from the Old English meaning well-being. And at Elevate, our mission is simple: to develop and deliver practical, actionable advice to help you achieve financial well-being and confidence in your plan. And we're so excited to bring you helpful content and hopefully remove some of the mystery that surrounds financial planning, and particularly when it comes to financial planning in your own lives, and help you implement these strategies to help you achieve the things that are most important to you. If you haven't already, be sure to check out our YouTube channel called WealthWise, where we are building out a full lineup of educational content that we hope is helpful to you, and breaking some of the content down into bite-sized pieces that are easy to digest. And we also, of course, host these monthly webinars where we love to take your questions. So speaking of questions, you may post questions throughout today's webinar in the chat box. I will be taking a look at the chat box or in the Q&A at the end of the session if time allows. And if time doesn't allow, I'll still take a look at your questions and get back to you with a response. So here we go. This month, we want to dive in and discuss some of the challenges that you may experience as a retiree when it comes to planning and managing your taxes. So without further ado, allow me to share my screen with you so you can see the content. All right, so the topic for this month is Savvy Tax Planning: How Tax Planning Changes Through the Four Stages of Retirement. So I want to just remind you before we get started to always seek professional tax guidance. You might be thinking, shouldn't my CPA be telling me about taxes? And yes, your CPA should and does tell you about taxes. But here at Elevate Wealth, we believe that we should take a team approach when it comes to managing your retirement income. And a lot of that has to do with taxes. So it's always best to consult a qualified tax professional to discuss your tax situation, especially when it comes to different account types, such as your traditional IRAs, which you have to pay tax on at distributions, your Roth IRAs, which they grow tax-free, and if you follow the rules, they can be withdrawn tax-free, and of course, state taxes. So for the purposes of today's presentation, I'll be talking about federal taxes, but as you all know, in many states, like in the state of Georgia, there are state income taxes that we need to consider, and sometimes exclusions for retirees. But again, today I'm going to be focused on federal income taxes, and always consult a professional tax advisor to discuss your specific situation. We are in a new and complex world when you enter retirement, and taxes in that accumulation phase or that savings phase are different than in the distribution phase. What is the accumulation phase versus the distribution phase? Well, the accumulation phase is just that. It's when you're working and earning an income and socking away dollars to put away nest egg to fund your retirement income stream. But what happens when you retire and you decide to take all that hard-earned money and turn that into retirement income stream? And this is a concept that for many of us is shrouded in mystery, and it can seem really complicated. And it requires a shift in thinking, and we must plan for that spending phase or that distribution phase. Many times when we make that shift, we lose something. We lose some of the typical write-offs that you think of when you prepare a tax return. So we have no more child tax credits because many times our children are grown by then. We have no more mortgage interest deduction a lot of the time, because our advice to our clients is always to try and pay off that mortgage before you retire. So no more mortgage interest deduction, and no more tax-free employer paid medical insurance or contributions to a 401k or similar items that come with being in the working world through your employer. So there are a lot of things that change when we flip that switch from working and into retirement. And then we add things like we add Social Security. At age 72, we add required minimum distributions. We add paying for Medicare and potentially for long-term care. So there are a lot of things that go away, but then there are some things that are added. And the taxation of those things is different. So having a plan for how to manage those and how to stage those things is really important. And don't be surprised to get hit by surprises in retirement. It sounds like an oxymoron to say common surprises, but there are similar situations we see retirees face that can catch them off guard. Things like inflation. We know inflation happens. It's happening right now. We're seeing that evidence every day all around us right now with prices on items that we buy, sometimes substantially higher than they were a year ago. So we know that we can buy more with our dollar today than we'll be able to buy in the future. So we have to plan for inflation. Longevity. People are living longer. The good news is people are living longer, and the bad news is people are living longer. So we need to make sure that our retirement income stream is going to provide for us no matter how long we live. Expenses. There are always unexpected expenses. How many times in your life have you encountered an unexpected expense? So sometimes you need a new roof, or sometimes you need a new AC unit. Sometimes we have an unexpected medical expense. Things always pop up. So we just always need to be prepared for the unexpected. And then, of course, healthcare. Healthcare costs are on the rise. They have been for a very long time. They outpace inflation. So making sure that your retirement income stream can supplement whatever health insurance you have, typically Medicare, but whatever health insurance you have, supplementing that is very important. So the problem that we see is people often pay more taxes in retirement than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. Let's break this statement down for a second. A confusing system, even Albert Einstein said that he didn't understand how to pay his, or how to prepare his taxes. It's confusing even for geniuses. Various income types. Do you know the tax treatment for each of your different types of retirement income? Hidden taxes and penalties. And I often refer to these hidden taxes and penalties as a domino effect, because a lot of times when you take additional income from one source, you may trigger a chain reaction, a domino effect that you didn't intend or didn't even aware was going to happen, simply because there were tax triggers that you didn't anticipate or you didn't know about. And we'll look at those, a few of those as we go through our presentation today. So we must develop a solution. And because your tax exposure changes throughout those 4 stages of retirement, you need a strategy that both anticipates possible traditional taxes and possible tax surcharges and penalties related to Social Security, Medicare, and other types of income. I know we just got started. I hope you're not overwhelmed just yet, but you may be thinking, how am I going to manage all of that? And you're in the right place, because that's what we're going to be focusing on. And we're going to give you today 4 keys that we need to pay attention to as we're working through 4 stages of retirement. So I'm going to talk briefly about what those 4 stages are and then dive into the first stage. So what are the 4 stages of retirement that all of these stages I've been referencing? And just to break it down, basically, we have first pre-retirement, and that is that accumulation phase that I was talking about earlier. Those are our work and save years, typically, of course, up to age 60 or up until you retire. And those are your work and save years. You're actively putting away funds in your different types of retirement accounts that's going to turn into your retirement income stream later. And then we move into early retirement, when you finally reach that finish line at work and you get to do what all of us dream of doing, which is retiring. And that, again, roughly age 60 to 70, depending on when you retire. And we affectionately refer to those years as the go-go years. Because what do you want to do when you retire? Why do you retire? Well, you want to go, and you want to do, and you want to see. And you want to experience all of those things that you've been dreaming about doing when you retire. So I know that early retirement stage or retirement in general has looked a lot different for folks over the last few years than anticipated due to the pandemic. But typically, that's not the case. Usually, in your go-go years, you're able to go and do and enjoy. And even in this pandemic environment, just alleviating the stress, or for some of us, what can be stress of a work environment, has been great. And we've been able to do a lot of things we wanted to do in early retirement despite the pandemic. So then we move into middle retirement. And again, rough age estimates, not to put anybody in a box here, but age 70 to 80. And we call those the go slow years. You work and you save and you go and you do. And then by the time you reach middle retirement, you're content. You're kind of settled into what retirement lifestyle looks like. And you may want to pursue hobbies or something like that, or slow down and spend more time at home, more time with family, more time with the grandkids, whatnot. You might not be traveling quite as much, or you might, but you're not doing quite as much. You're just really kind of settled into that retirement lifestyle. And then lastly, we have the fourth stage, late retirement, again, age 80 plus, and that really depends. But the description for this one is the no-go years. At this point, we've done everything we wanted to do, retirement, or at least hopefully accomplished a lot of it. And this phase can be accompanied by health issues or things that really slow us down. And this can also be one of the most expensive phases of our lives as we start to incur medical expenses here. So, very simply broken down, this is what I'm referring to when I say those four stages of retirement: pre retirement, early retirement, middle to retirement, late retirement, work and save, go slow, no go. And it makes a big difference because your spending changes as we move through these four stages of retirement. So let's start today by talking a little bit more about pre retirement, or your accumulation years. And like I said, this is usually between the ages of 50 to 60. Those are your work and save years. And you may be thinking now, okay, what's the first thing I need to understand about retirement and taxes? And key number one, we think, in pre retirement is you have to know what your after tax retirement savings picture looks like before retiring. So let's say that during those working years in your pre retirement phase, you saved about $500,000 in your IRA. But as you know, it's not really $500,000 in your 401k or your IRA. And that's because you were able to save all of that money pre-tax, which means that every dollar that's in there that you pull out for a retirement income stream is fully taxable. So planning for how you take these dollars out is really important. Because if you're married filing jointly and you have $500,000 in a 401k or in an IRA, which have similar, same tax provisions, and you're at a 35% tax rate, your $500,000 is actually worth $325,000 after tax. Or if you're in a higher income tax bracket, 37%, your $500,000 is actually worth $315,000. So your $500,000 is worth less because every dollar has a portion of it that's dedicated to taxes. And in addition, you're going to have to withdraw a required minimum distribution each year after you turn age 72. So one of the best things that you can do in your work and save years is diversify how you save across different types of accounts. And we affectionately call this the tax buckets. We have three tax buckets. We have tax deferred, tax advantage, tax free. And those names are meant to define how the money comes out in retirement. But simply put, for this bullet point, when we're talking about 401ks or traditional IRAs, we're talking about that tax deferred bucket where money went in pre-tax. It's allowed to grow forever inside there without any tax implications. Not forever, I misspoke there. But when it comes out in a retirement income stream, or when you start to have required minimum distributions, those dollars are taxed forever at your ordinary income tax rate. So they're taxed to you when you pull the dollars out. They're taxed to your heirs when they pull the dollars out. These dollars will forever have tax because the IRS allowed you that benefit of putting the money in pre-tax. So flip over to the bucket on the right-hand side of this page, the tax-free bucket, and that's the Roth bucket. And it's really hard to get money inside a Roth IRA because number one, there's income limits on putting money in, and there's also a cap this year at $6,000 and an additional $1,000 if you're over 50 per individual. But you can put that money in. It's already been taxed. So you've already paid tax on those dollars when you put it in. And then it's allowed to grow inside tax deferred. So no taxes while it's growing. And when you pull it out after age 59 and a half for your retirement income stream, it's never taxed again. It's tax free. Okay. And that money can also be tax free to you or to your heirs if you leave them a Roth IRA. So by the time you turn age 72, most retirees are stacking up income sources, like in this first tax deferred bucket. If you have a pension, if you're so lucky enough to have a pension or an annuity, there's your first layer. Then you've got your withdrawals from your IRA or your 401k if you need that to supplement your income, plus Social Security, which is somewhat taxable, and we'll talk about that in a minute. And then add required minimum distributions to that if you're not taking enough from your IRA. So every time you do those things and you take out those distributions, you're potentially raising the bar on your marginal income tax bracket. So if instead, sorry, let me go back for a second to that tax bucket slide. If instead of saving all of our dollars in that pre-tax bucket in our pre-retirement years, if we're making a focus to save in the Roth, or even in this middle bucket, which we call tax advantaged, this would be like a brokerage account, savings accounts, but this type of investment account that doesn't have any of those quote unquote tax strings attached, like retirement accounts do. If we're putting a focus on saving in that middle and that right bucket, as well as saving in the first bucket, then we diversify our income streams. And when we are building that stream in retirement, we can have some choices about which blocks we use in any given year to build that stream and to be really efficient with our tax strategy. So to wrap up the pre-retirement phase, the keys to consider are the true after-tax value of the retirement savings accounts that you've built up, and how to save across all the buckets of account types before you can retire. Because being successful in retirement starts by saving early and often. And then that's amplified by saving intentionally in different account types. So it's really important to consider the value of your retirement savings accounts after taxes. And we know that. So now we may be thinking, okay, my accounts may not be worth as much as I thought because now I know that all of those dollars are taxable, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to help pay my healthcare costs. And for most of us, that's true. And as long as we've worked in systems that contributed to our Social Security and we qualify for Medicare, those are two great benefits that we have as Americans. But the key here is that Social Security and Medicare have their own tax traps, and we need a plan for them too. So what do I mean by tax traps? And let's take a look and talk about Social Security and taxes. And to do that, I'm going to throw out a tax brain teaser. So let's talk about our friend Bill. Bill is retired and he has taxable income of $42,275. He's a single filer. He falls in the 22% marginal tax bracket with his income. That includes $38,000 in IRA income plus $25,000 in Social Security benefits. So Bill wants to go to a concert. So he taps his IRA to take out an extra $1,000 for that concert road trip. How much will he owe in taxes on that extra $1,000? So let's talk about that. If Bill's in the 22% tax bracket, then he pays 22 cents in federal income tax for every additional dollar. So if he took out $1,000, he should owe $220, right? Well, it'd be too easy if I gave you the right answer up front, right? That's wrong. He owes $407 in tax, which is a 40.7% tax rate on that income. Now, why is that? Why does he owe a 40% tax rate when he's in a 22% federal tax bracket? So let's look at how that income triggered additional taxes and talk about Social Security and taxes. So remember that he took out an extra $1,000 to go on the road trip. So before the road trip, his IRA income was $38,000. After the road trip, his IRA income was $39,000. He has the same Social Security benefit of $25,000, but his adjusted gross, of course, is higher. And why is his adjusted gross income higher than $1,000 higher? And it's because our friend Bill got hit by what we call the Social Security tax torpedo. So as you can see here, his adjusted gross income, even though he only took $1,000 out, went up by $1,850, as did his taxable income, up from $42,275 to $44,125. So why is that? And that's because your Social Security is taxable based on all of your income put together. So Bill was right on the edge of a bracket that pushed extra Social Security dollars into that bracket and made it taxable when he took out the $1,000 from his IRA. And as you can see here from the yellow box or the yellow highlighted items here, for every additional dollar of income Bill received, an additional $1.85 was added to his adjusted gross income and his taxable income. So his extra Social Security became 85% taxable, or the dollars that were pushed into that bracket became 85% taxable, which caused an increase in income tax from scenario 1 to scenario 2 of $407. And that's an effective rate of 40.7% versus his stated marginal rate of 22%. So that's what we call the Social Security tax torpedo. It's one of those domino effect items that I mentioned. Every additional dollar that once you cross certain thresholds in certain brackets can cause other dollars to become taxable. Medicare and taxes. Similar concept here. We also need to pay attention to Medicare, and we need to watch for what's called the IRMAA cliff. IRMAA, a beautiful acronym. We love acronyms in our industry. IRMAA stands for Income-Related Medicare Adjustment Amount, and it has to do with the premium that you pay for Medicare. The premium you pay for Medicare, once you turn 65 and you're eligible, is based on your modified adjusted gross income, and it has its own bracket schedule too. So let's look at a scenario to illustrate this. George and Martha have Medicare Parts B and D. Medicare Part A is free and you pay for B and D. In 2018, actually, I think it's 2019. Yes, Magi here, 2019. Their modified adjusted gross income was $275,500. Well, maybe George and Martha also wanted to go on a road trip and they needed $1,000. So they sold a stock that generated $1,000 capital gain. So you would think that they would owe $188 in tax. Their regular tax rate plus a $38 what we call net investment income tax. And the reasoning for the 150 is capital gains in their bracket are taxed at 15%. So their $1,000 capital gain would have generated a 15% capital gain tax, $150. And also because of their income bracket, they're subject to what's called the net investment income tax of 3.8%. So that's another $38. So they should owe an additional $188 in tax. Am I right? Well, as you know from the last example, I don't like to give you the answer up front. It has to be a trick question. So no, they're not right. That's not right. And the reason that that's not right is not only did they get hit with those additional taxes, the capital gains and the net investment income tax, but they also now have to pay a higher Medicare premium because their modified adjusted gross income jumped from one bracket to the next. So it's not technically a tax, but it is an increase in their total monthly Medicare premium. So what happened to George and Martha is not taxes per se. It's just that they will now, for a year, have to pay a higher premium on their Medicare. So when their income was 275.5, they fell in this third bracket tier here. And for each of them, their total monthly premium amount was $297. But since they jumped over 276,000, now their Medicare premium also jumped to $386 for each of them for the year. So that also affects, this is for their Part B. That also affects their Part D. They jumped up to that next tier as well. So where they were paying $31.80, now they're paying the additional $51.20 each month for Part D. So they had their $188 tax, but now they also get to pay extra Medicare premiums each month. And this is how their surcharges break down, which means a combined additional $2,600 in Medicare premiums for the year. And this is what that looks like. They sold the stock, had a $1,000 gain, $188 for the capital gains and the net investment income. Stock sale triggers the new IRMAA tier. The total IRMAA surcharges were $2,600. So that $1,000 gain amounts to an extra $2,792, which is a 279% real tax rate. So the good news, if there's any here, the good news is that for IRMAA, so sorry to skip ahead. The good news is that for IRMAA, for those Medicare premiums, they only last for a year. So what Medicare does is they look back to your income from 2 years ago to decide what your Medicare premium should be for the current year. So for example, in 2022, Medicare premiums, they're using your modified adjusted gross income from 2020 to determine those Medicare premiums in the current year. And so George and Martha will have some opportunity this year to plan to stay within a certain bracket, potentially not take capital gains, so that their Medicare premiums don't escalate again in future years. And hopefully if they can stay in that tier, instead of hopping ahead to that next tier, they'll drop back down into that lower rate. So just remember that things happen. And sometimes when we do things like maybe we've sold a property that we've held for a long time and we generate a higher than normal capital gain in 1 year, that these things like additional Social Security or Medicare IRMAA adjustments can be triggered. But they are temporary, and those do adjust if we go back the following year, if we manage our bracket maybe more efficiently, or we don't have those unexpected or outstanding items, then we can drop back down to lower tiers. So you may be wondering, you may be thinking, wow, are there other tax traps that we'll face in retirement? And I wish I could tell you no, but of course, here we are to talk about tax traps. So yes, this is where key number 3 comes in, which is you must plan how and when you will use taxable, tax deferred, and tax-free assets to manage your income and tax brackets efficiently. And what do I mean by that? So in figuring out how to stack those retirement income blocks, that's how we can help manage those taxes and minimize the effect of taxes long term. So think back to our discussion of saving for retirement in phase 1, pre-retirement. And we talked about those tax buckets, which are exactly what's defined here in key 3: taxable, tax deferred, tax free. And on our chart, we had it the other way. We had tax deferred, taxable, and then tax free. But by saving across those different tax buckets, you've probably accumulated some assets in an IRA or 401k, maybe a Roth IRA, and then maybe you've got some assets in just regular investment accounts or savings accounts there in the middle that get a tax advantaged treatment is what we call that. So just like Sam and Mary here, let's take a look at an example. Sam and Mary, they want to spend $8,500 a month in retirement. And here's how their assets look. They each have an IRA of $450,000. They each have Roth IRAs of Sam's says 600,000, but I think that's a typo. I think they each have 60,000. And then they have a joint bank account of 300,000. So which accounts to spend first? And there's some conventional wisdom about this that has been developed over time. And the conventional wisdom says spend taxable money first, meaning bank accounts, investment accounts that generate capital gains, those things that have little to no tax ramifications, or like individual or joint investment accounts that get tax advantage or capital gains tax treatment. Then spend tax deferred money like your IRAs. And last, spend your tax exempt money like your Roth IRAs. So that's conventional wisdom. And it has worked over time. And for some clients or some folks that we advise, that spending order works just fine. But there have been a lot of studies done on this over time about maximizing how you take your funds in retirement. It's called withdrawal sourcing, in order to have the most tax efficient withdrawal strategy. So taking some of these studies and science into account, we have some alternative approaches. So perhaps instead of just spending your taxable money first, you do spend the taxable money first, but you also consider around that time converting some of your IRA money to Roth IRA while you're in lower tax years. And then when you have the most flexibility, let's go ahead and get some of those dollars that you've been building up all this time into a vehicle that's not going to be taxed ever again. And then we spend our tax deferred money until it's depleted. And then lastly, we spend our tax exempt money. And if we do this, perhaps our tax exempt bucket becomes a lot bigger over time and at the end of the day than it would have been if we had not converted any funds from our IRA into our Roth IRA. So here's an example considering Roth IRA conversions. We have an IRA or similar retirement funds like a 401k, but for this illustration, we'll use IRA, and that's moved to a Roth IRA. And when we move funds from an IRA to a Roth IRA, it is fully taxable at your ordinary income tax rate. So that taxable amount converted is added to your income. And in this example, Jill converts $100,000 from her IRA to her Roth IRA. So what Jill will have to do is add $100,000 to her income. And that conversion income is taxed at her marginal tax rate or her ordinary income tax rate, whatever that is for the year. And that may accelerate her into a higher bracket. We'll see. But what we want to do is something we call filling up the bracket. So this is a simple bucket example of before the conversion for Jill, where she may have filled up her 10% bucket and her 12% bucket, but her 22% bucket is only half full. So when we think about converting for her, her 10 and 12% bucket is already full, and we've just filled up that 22% bracket without spilling over into the 24% bracket. So that is completely fluid, as this example shows, and something that in your early retirement years, you have a lot more control over and a lot more flexibility over before you start doing things like taking your Social Security, which adds some taxable income, or required minimum distributions, which add more income. So early in retirement, we like to fill up the bracket. Early and middle retirement, we like to look at filling up those tax brackets, because let's face it, we are probably in one of the lowest tax bracket situations that we've seen in a very long time. And the decision point is, do we think tax rates are going to be higher or lower in the future? And while we don't know that answer, I think that we can make the assumption that tax rates are probably going to be higher in the future than they are today. So it makes sense to fill up what we consider lower tax buckets or brackets. So low income years are good for Roth conversions. And Roth IRA conversions in years with unusually low income may be beneficial. What do I mean by unusually low income? Well, Some folks saw unusually low income just 2 years ago in 2020, or even into 2021 with pandemic effects. Maybe if you're a business owner, you had unusually low sales or you had unusually high expenses. Maybe for the rest of us, there was a year when we had higher than normal medical bills that were deductible. And again, like I mentioned before, after retirement, but before receiving Social Security benefits or pensions or IRA distributions, those are always good times to consider Roth conversions because they're typically times when we have more room left in those tax bracket buckets. Go ahead. So, important question here is what's guiding the goal? And you must know whether you're trying to keep income below a bracket threshold to avoid bumping up to the next higher rate, or whether you're trying to increase that income to fill up a bracket to take advantage of that rate. And that's what I meant by thinking through where taxes are now and where they could potentially be in the future for you. And there's things that we help our clients think through, like what does a required minimum distribution look like at age 72? How high is that going to be? And how is that going to impact my income down the road? And how is that going to impact my tax bracket down the road? So let's shift for a moment and talk about charitable giving and tax planning. Because obviously, for those of us who are philanthropic, we tend to give out of the kindness of our hearts and because there are organizations that we feel compelled to support. But we can also do that at the same time as we get a tax benefit for our gifts. The Tax Cuts and Jobs Act that became effective in 2020, which is the current tax structure that we're under, did away with a lot of itemized deductions. But then it also increased the standard deduction. And for many retirees, it increased the standard deduction to a level where they're no longer able to get a tax deduction for charitable gifts. So then what are some of the ways that we can continue to give to charity and still get a tax benefit on that? And this is one of those ways. We're going to use our couple Albert and Shirley here as an example. They're in a 24% tax bracket. They give $5,000 to charity. They have $15,000 in existing itemized deductions. But for last year, for example, the standard deduction for Albert and Shirley was $27,800. So if they gave $5,000 donation and we add that to their existing $15,000 in itemized deductions, that's only $20,000. And that's not more than their standard deduction, which means they won't itemize. So they won't get a separate and standalone benefit for that charitable gift. So what do we do about that? Well, if they're over age 70 and a half, we can do something called the qualified charitable distribution. And what that means is that once you reach age 70 and a half, and this is a distinction now, it's 72 is your required minimum distribution age, but you can still do qualified charitable distributions at 70 and a half. You can give up to $100,000 from an IRA per person. It must go directly to the charity. And it will count as your required minimum distribution if you're 72. But even if you're just 70 and a half or older, it's not reported as income. And there's no deduction on your income tax. So when I say not reported as income, you still get a 1099 form, the tax form for the distribution. But when your tax preparer does your return, they note on the return QCD, and it's not taxable. And then you don't use it as an itemized deduction on your income tax return. So here's an example of how that works. Option 1, what's the cost of a non-QCD contribution? The charity gets $5,000, and the $5,000, if you're at age 72 or older, satisfies your required distribution or part of it. $5,000 is reported as taxable income. And the tax bill on that distribution at a 24% tax bracket is $1,200. So this is if you did not do the qualified charitable distribution strategy. You took out $5,000 from your IRA and you gave it to charity. Then the total cost of your contribution would be $6,200. The $5,000 that was taken out plus $1,200 in income tax. Now, instead, what if we do option 2? What's the cost of and I think this is a typo also, it should be a QCD contribution, the charity gets $5,000. The $5,000 satisfies the RMD, and $5,000 is excluded from taxable income. So, like I said, you get a 1099 for taking the $5,000 out, but it went directly to the charity. So when you report it, it's not reported as taxable. And that tax bill is zero on that distribution. So that's a $1,200 savings just by handling it with a direct gift to charity rather than taking it out of the IRA and giving it to the charity. So just remember, in the third stage of retirement, middle retirement, that making sure we're implementing strategies that are managing required minimum distributions to help keep taxes in check and your Medicare premiums lower. Those things are really important. And now to transition to the last of the 4 phases as we discuss late retirement. Again, usually age 80 to 90 and up. We've gone from pre-retirement or work and save years to early retirement, the go-go years, to middle retirement, the slow-go years, to finally arrive at late retirement or the no-go years. And while the term no-go years sounds sad, it's actually just a practical way to define that period of time when hopefully we've done many of the things we wanted to do in retirement. And then we've arrived at a period of life where that can be accompanied by health issues or really slowing down. And unfortunately, it can be one of the most expensive phases of our lives as we start to incur medical and long-term care expenses. One of the main concerns that we hear out of clients in this phase is, I hope to have assets to pass on to my family. How does retirement tax planning figure in? And the obvious answer is that the less you pay in tax, the more you have available to pay for care or to pass on to your heirs or to make bequests. And that's why key number 4 is so important. Organize your assets for your family's benefit. Estate planning still matters. So, even though for a lot of us now, the estate tax exclusion is really high, like $12 million or $24 million as a couple. Some folks tend to think that estate planning doesn't matter because the estate tax exemption is so high, but it does matter how you organize those assets for your family's benefit. So what do I mean by organizing your assets? Well, different types of accounts get different tax treatment. And in this example, we're going to look at what we call a step up in basis strategy. And the definition of this is a rule that treats a beneficiary as if they purchased the inherited asset on the day it was left to them. Future gain or loss is based on the asset price on that day. So with estate planning, our goal is to make sure that beneficiaries are designated, that accounts are titled in a way that they will pass most efficiently to our heirs. And this is a strategy to do that. So let's look at our example of Phil and Mary. Phil and Mary have a joint brokerage account. It's titled JTWROS, which means joint tenants with right of survivorship. And what that means is if one spouse passes away, the other spouse automatically owns the entire account. So inside that joint investment account, Phil and Mary have $120,000 of long-term capital gains with their investments. And unfortunately, Phil is diagnosed with a terminal illness, and his physicians tell him he may have about 18 months to live. So when that happens, Phil and Mary come to an advisor and they sit down and they want to go through their accounts and their estate plan to make sure that everything is in order. So let's take a look at a couple of scenarios that Phil and Mary have here to maximize their assets. Scenario 1 is just do nothing after the diagnosis, right? Like leave the accounts and everything set exactly as it is. And if that happens, if we make no moves at all, it's still advantageous to the assets at the end of the day. Phil dies, unfortunately, and Mary inherits Phil's half of the joint account. So the step up in basis on that half of the account eliminates this long-term capital gain on $60,000. But the other half, $60,000, was owned by Mary, so she still has a capital gain there. And if she sold all the investments, she'd only owe income tax on her half of the capital gains, right? So she would owe long-term capital gains on her $60,000 plus any gain on the remainder after Phil's death. So the bottom line is that Mary would owe income tax on her $60,000 of gain plus any gain that occurred on Phil's half after he died. Scenario 2 is that after the diagnosis and doing some planning with their advisor, they move all their investment accounts into one account in Phil's name. And this would be a strategy thinking, okay, we have a diagnosis now and anticipating that Phil would predecease Mary. And sure enough, unfortunately, Phil dies 18 months later. But at that point, Mary inherits the entire account that was in Phil's name with gains of $120,000. And Mary can now sell that account and pay zero in taxes. So thinking about how accounts are titled and when certain life situations happen, involving your advisor and making sure they're aware of the situation and helping to do a little tax planning at the time, even though we don't, of course, none of us know what's actually going to happen, but anticipating what could happen, we can make some strategic changes that could make a big difference when you're thinking about leaving a legacy and providing for your heirs long term. So just a question, when you go to sell your investments, would you rather owe tax on $60,000 in gain or no tax? And I think the obvious answer for all of us that we would rather owe no tax so that that money can then be distributed to our heirs or to our bequests or how we would like at the end of the day. In 2020, a question that we get a lot is about inheriting IRA assets. So I thought I'd touch on that really quickly. You have some choices when you are a beneficiary and you inherit an IRA. And the Secure Act that took effect in 2020 changed how beneficiaries inherit IRAs. So beneficiaries now, if you are a spouse and you inherit your your deceased spouse's IRA or the surviving spouse, you can take on that IRA as your own, and then you would not have a required minimum distribution until you were eligible for required minimum distributions. But non-spouse beneficiary rules have changed, and they're not as favorable as they used to be. Now we have what's called the 10-year rule, which means that beneficiaries that inherit an IRA account, even a Roth IRA, have 10 years to fully distribute that account. Whereas in the past, they were able to stretch that over their life expectancy, and they can no longer do that. So here's an example. Pamela is age 65, and she has a son named Kyle who's 40. Unfortunately, Pam dies and leaves 100% of her traditional IRA to her son, Kyle. The IRA balance was $400,000. And just for purposes of illustration, it's a 6% average annual rate of return. So scenario 1 is Kyle takes distributions over 10 years to minimize the tax. So now because of the 10-year rule, you can take distributions in any year you choose, but you have 10 years total to take all the account out. So you can take a distribution every other year, you could take one big distribution, but for Kyle, he chooses to take that distribution over 10 years, just an even amount every year for 10 years. And that equates to an annual distribution to Kyle of $54,347 a year. And what that means for Kyle is that in those pre-retirement years where he is working and hard to save money, he's going to have to add to his taxable income $54,000 a year, which more than likely is going to bump him into a higher tax bracket. Scenario 2. Kyle does nothing in years 1 through 9, and he takes a full distribution in year 10. So Kyle was listed as the sole beneficiary. He has 10 years to take out all the distributions. And instead of taking $54,000 a year, he waits until year 10. And now the balance of that IRA is $716 because it's grown 6% a year since he inherited it. And now he has to take out all of those dollars. And do you think that's going to increase his tax liability? Absolutely. He's going to get hit with at least a 37 to 39% tax on that $716, which is going to basically erase all of those gains from that 10-year period. So it's really important For you, as the person who has the IRA and who's thinking about how to leave that asset, it's important to think about naming beneficiaries. Of course, a lot of us want to leave those IRA accounts to our heirs, but thinking about your estate plan, if you have charities that you want to leave funds to, charities are great beneficiaries of traditional IRAs because they'll inherit those funds, or they will inherit those funds from you tax free. So if charitable giving is part of your estate plan, a suggestion would be look at how much it is that you want to give a charity and name them as an IRA beneficiary rather than giving those assets that are in taxable accounts, because your individual people heirs could inherit those tax free. So that's just a thought when it comes to estate planning and organizing your assets so that your heirs or your charities or whoever you want to leave your funds to receive those in the most tax efficient manner. Really quickly, I'm going to touch on just taxes and long-term care, because I've mentioned several times in this presentation today that late retirement phase, our slow go, our no-go years can be really expensive. And a lot of that is due to healthcare and retirement. And a lot of that can be due to the long-term care or the care we need in the final years of our lives, whether that be home care or facility care, skilled nursing care, that type of care is really expensive. So there are several ways that we can plan for long-term care expenses. Long-term care insurance is something that folks buy, and those premiums may be deductible at federal level and at state level, and those count as a medical expense. So you can take your long-term care insurance premiums plus all out-of-pocket medical expenses, add those up. If that's more than 10% of your adjusted gross income, you can use that item as an itemized deduction on your tax return. But again, because the standard deduction is so high now, a lot of my retired clients are not able to use those premiums as deductible expenses. But payments from policies for reimbursement of long-term care expenses are generally tax-free. And choosing how to pay for long-term care costs can have a big impact on your heirs. So if you, one thing that we do as advisors is we try to anticipate what long-term care expenses would be, build that into your plan, and think about the tax impact. Maybe those expenses at the end of your life are so high that you're able to itemize your medical expenses and therefore get a higher deduction. Maybe then we can use some of our IRA funds to fund our long-term care and take advantage of taxes in that way. So it's certainly something that needs to be discussed and built into your long-term plan, but it can be complex. So my advice is to, of course, consult your advisor and your tax professional when it comes to thinking about taxes and long-term care planning. So to recap, in late retirement, it's important to make sure you've thought through how to organize your assets and plan for retirement and plan for long-term care so that you can leave whatever legacy it is that you like to leave in the most tax-efficient manner. Okay, we've been through a lot today. And goodness, you may be thinking, how in the world will we ever manage this? It is a lot to think about. It's a lot of moving parts. It's a lot of phases and stages. So, we know we're going to pay taxes. What is certain? Death and taxes, right? As the old saying goes. So we certainly work with each individual retiree situation to make sure that we're aware of what we know is going to happen and try to anticipate the unexpected. That distribution phase is complicated. Managing tax happens throughout retirement. So I mentioned earlier, mistakes can be costly, but most of the time we can take the mistakes and turn them into something that's more favorable tax situation the next year, or just do a little bit better planning. But how will you manage this? And that's what we're here for. We're here to help you through these 4 stages of pre-retirement, where we want to know what your after-tax savings is before retiring. We want to think through early retirement and have the most flexibility that we can in that early retirement to fill up those tax brackets. One thing I didn't necessarily mention is that the decision to retire and to take Social Security are completely separate. So managing those early retirement expectations is important. when do we trigger Social Security? When do we pull the trigger and apply for those benefits? And we can help think through a strategy that helps you fill up those brackets before you start that Social Security benefit. And then by the time we get to middle retirement, we've already started Social Security, we've got our Medicare going, and we want to make sure that we have managed and we planned for the most efficient way to take our required minimum distributions. And of course, late retirement, which a lot of this late retirement planning happens before we get to late retirement. It's organizing those assets for tax efficiency in estate planning. And that really goes back into pre-retirement and early retirement and how we have saved and how we can organize and title our accounts to make sure that everything passes most efficiently to our heirs. You need a solution. And because your tax exposure will change throughout retirement, you need a tax strategy that anticipates how and when you tap those assets to cover your expenses, that understands the range of taxes you'll face at various stages, and that manages your actions so that you pay the lowest tax rate possible. So we've covered so much, and I would just want to overemphasize that that's what advisors like us are here for. So feel free to request a taxes and retirement planning overview meeting or just a review meeting if you're a client. And if you're not a client, feel free to reach out to us to learn more about Elevate Wealth and what it is that we do and how we help our clients. But we feel very passionate about educating our clients. We feel very passionate about building tax efficient income streams, and we're here to help add value to your long-term planning situation. So that is the end of my presentation today. And I mentioned that I was going to keep us on time, and I think I went a few minutes over. So if you submitted questions, feel free to go ahead and put those in if you have them now. If not, no worries. You may reach out to us at elevate-wealth.com. If you submitted questions, I will review those and get back to you via email or the method in which you registered. And we're really grateful that you were able to join us today. And we wish you all the best of success in whichever phase of retirement that you are in. So feel free to connect with us on social media. As I mentioned, we have a YouTube channel, WealthWise. We do these webinars monthly. And if you have any topics you'd like to suggest, we're all ears. We'd love to hear what's on your mind and how we can share information with you that we feel like is timely and relevant to your lives, whatever phase of retirement you may be in. And that includes pre-retirement. So thank you again for joining us. Feel free to take a look at our website, elevate-wealth.com, and we hope to see you here next month on our monthly educational webinar series. Thanks so much. Have a good day.